Very much for inviting me to participate in this conference. Unfortunately, only remotely since it's my teaching semester, and so I'm teaching climate finance tonight. I think this paper fits very nicely, following on from Hyun, who gave a great great paper and overview also on the financial risks related to climate change. This is joint work with Stefano Giglio, Teresa Kuchler, and Xuran Zhang. And we were motivated to think about this topic, given sort of this broader recent interest in understanding and ultimately managing the complex relationships between the economy and the health of our planet. Again, sort of from a financial side, really trying to think about what the role of the financial sector is, what the implications for asset markets are, what the potential implications for financial stability are, and so on. As we just saw in Hyun's presentation, there's been sort of a burgeoning research agenda in this field that I would broadly call climate finance. So questions around how does climate change affect economic activity and asset values, and the role that financial markets can play to accelerate the green transition. There's kind of an equally important, but I think much less studied theme, and I was really excited to see, that while it's much less studied, it's kind of an equally important part of the conference you put together. That's around the economic and financial implications of biodiversity loss. We think that the biodiversity loss could be similarly important to climate change in terms of its overall economic impact. But there's also much less that we know about it. And so what we're going to try and do in this paper is really take some very first baby steps in terms of attempting to measure biodiversity risks over time and across firms, and really trying to understand the extent to which those risks are already affecting economic activity and potentially asset values today. I'm going to preface this by saying this is really the first sort of, again, baby step that we're taking here. And so, we're going to try and make reasonable decisions at every step of the empirical analysis. But we're very open and very hopeful that other people will, enter this field, start thinking about this, build on what we've done, criticize what we've done, and really try and help us better understand this question. In order to facilitate that, and I'll come back to this in the end, we have released all of the data and all of the measures of aggregate and firm and industry level risk exposures on a special website, biodiversityrisk.org, that I hope will sort of start as a building block in terms of a broader understanding of at least the finance professions of the risks of biodiversity loss. So what do we mean by biodiversity loss? We're going to broadly define it in this paper as the sum of genes, species, and ecosystems. And in doing so, we're intentionally taking a somewhat narrower view than what's an even broader topic called natural capital, which might include, in addition, things like water scarcity and so on. Why did we make that choice? In some sense, we made that choice because biodiversity in itself is already highly complex. It's much more complex, much more multifaceted than climate change as a topic to think about. And so in order to make any progress, we thought we would limit ourselves to this, not to discount the importance of things like, water scarcity for economic activity, but just to turn it into something that might be a little easier to handle from an empirical perspective. And when you look at the literature, you see estimates of the losses of ecosystem services to the economy, and that those losses has caused damages of anywhere between $4 and $20 trillion per year. Those are very large numbers. There's also a very, very wide range. And when you look in these papers, it sometimes, is a little bit difficult to figure out at what point you draw the line and you stop calling it natural capital or ecosystem services. You can go all the way to the extreme and say all economic activity depends on the ecosystem because we need oxygen to breathe. And if it was gone, we would all be dead and there'd be no GDP. Again, none of the papers go all that far. I think there's some uncertainty about where you should draw the line, about what you think about as the economic contributions of biodiversity. But either way, whichever approach you take, wherever you end up drawing the line, you're going to end up with very, very large numbers. There's two mechanisms through which loss of biodiversity might affect economic activity. And again, in this paper, we're going to take a relatively narrower perspective. We're going to try and think about how it affects firms' economic activity. Just to give you the three types of examples of the first category, which is physical biodiversity risks, which basically come from the direct effects of losses of biodiversity and ecosystem services. So things like deforestation or habitat loss, can lead to lack of raw material and supply chain challenges for a whole range of firms, anywhere from paper to furniture, to a whole range of other industries. Secondly, the loss of species or genetic biodiversity can affect the R&D sector of pharma and biotechnology firms. I'm going to provide sort of specific evidence for that. And then sort of more broadly, biodiversity loss can lead to broader disruptions of ecosystems and economic activity, to increased vulnerability to climate change, etc. Now, these are just a few of the mechanisms, as you start thinking about why would we think about biodiversity loss, not as something that we only care about per se, right? There's sort of an intrinsic value to having species variety, etc., but also why we want to think about it from an economic perspective. The second mechanism is when we think about transition biodiversity risks. So those are risks to economic activity that come from responses to reduce biodiversity loss. All types of regulatory activities, such as land use regulations, sustainable forestry requirements, etc., can make it much more expensive to operate for firms in the energy sector, for firms in the transportation sector, etc. But also shifts of consumer preferences. I think a big example here is shifts away from palm oil use due to its effects on deforestation, or reputational costs that have increased substantially from things like causing oil spills or something like that. These are all, broadly speaking, transition biodiversity risks for firms. We'll see in a bit about which of these two risks, at least from the perspective of companies, is more important. But just to kind of start out, these are the types of mechanisms, the types of channels that you would think about if you start trying to figure out, okay, why should I think that biodiversity loss, which is tragic in of itself, might actually also affect economic activity, through affecting economic activity might affect asset values, and maybe even down the road financial stability, though I think there the evidence is at best at an early stage. I don't think we have any evidence yet that biodiversity loss is necessarily a financial stability risk. So the first thing that we wanted to do in this project is to, again, this being very, very early in this research agenda, to broadly understand whether or not biodiversity risks are risks that we should think about more, that we should worry about more from a financial and economic perspective. We wanted to ask, well, how do other people, how do other researchers, but also how do other market participants and how do regulators think about these risks? Do they think they're important or do they not think they're important? And so the first thing we did is we ran a survey of the perceptions of these types of risks amongst finance academics, professionals, public sector, regulators, and policy economists from around the world. We got about 700, just under 700 responses to the survey. Now, there's absolutely no claim that anything in the survey is representative, right? You have all the same concerns that you generally have about who responds to a survey, who you reach out to, etc. So this is not a claim about an overall sort of, representative set of numbers, but it is a first type of indication about whether or not people in those categories think that studying biodiversity risk from a financial perspective might be a promising avenue to go. So what do we find? First question we ask people is to try and classify whether or not they perceive both either these physical biodiversity risks or these transition biodiversity risks as financially material for corporations in the United States. Again, we had to sort of narrow the geographic scope of the question somewhat, just because in particular, when you think about transition risks, which are very much affected by local types of regulations, where in the world you are would very much affect the extent to which your operations are affected by these types of risks. So when we ask this question, we find that at about 70% of respondents perceive physical and transition biodiversity risks to have at least moderate financial materiality for firms in the US. So this is the first column that you see here, both for physical risk and for transition risk, when I pool across all of the respondents that we have. So about 70% of respondents think it's either moderately or very important. There's a split about half-half, 35 roughly find it very important and 35 roughly find it moderately important. One interesting thing for us was that private sector respondents report by far the highest perceived materiality of these risks. And that reminds me of where the climate finance literature was about 5 or 6 years ago when I started thinking about climate change as something that might affect financial markets. And I went around and asked my colleagues if they thought that this was something that was important. I think the general response was, well, we think climate change is a problem, but it's not an economic problem, it's a social problem. But the economic effects are going to be small. Yet when you talk to people in industry, they had already started to understand that the financial materiality might be bigger. Now I think academics and regulators very much agree that climate change can have large-scale financially material implications. Again, biodiversity loss looks a little similar in the sense that the private sector has a much higher probability of perceiving the risks as financially material relative to the academic sector. There's a question whether or not the academic sector's perception will converge to that of the private sector or the other way around. The second question we asked was about what time horizon if people perceive these types of biodiversity risks to materialize, if they're already important today and if they're going to come at various points in the future. And here the takeaway is that only about 20% of respondents believe that the risks are already materializing today. In the short run, people think that the transition risks, i.e. those that come from regulation to prevent biodiversity loss, that they're going to be more important than the risks, the physical risk materialization, the actual losses that come from the loss of biodiversity. Okay, so with that as a little just setting the scene of how people are thinking about it, we said, okay, we should really try and study formally whether or not biodiversity risks are priced in equity markets. That's kind of the first step that we have in finance to try and figure out, is this a risk that people worry about? Is this a risk that people are willing to pay to avoid? And subsequently, which is a very related question, as we'll see, can we use financial markets to share and hedge the underlying biodiversity risks? Now, the way that we traditionally do this in finance is that we would form long-short portfolios based on the underlying risk exposure, right? So you would form portfolios that, where you go long the firms that have a lot of biodiversity risk. You go short the firms that don't have a lot of biodiversity risk. You control for other risk factors. And you're trying to see whether or not that portfolio that overweights firms with a lot of biodiversity risk exposure, whether or not that portfolio outperforms the market or has higher expected returns than the market. Why? Well, if it does, then it suggests the risk is priced, right? Investors require extra expected returns in order to be willing to hold firms that are exposed to either physical or transition biodiversity risk. Now, in practice, we never ever observe expected returns. And so what we would do is we would proxy for expected returns with realized returns. We would say over very long horizons, average realized returns will approximate expected returns. That approach to seeing whether or not a risk is priced is just not going to work for relatively new risk such as biodiversity risk. Why? Well, we need decades of data in order to be able to get precise measures of realized returns to then call it equal to expected returns. So you need tons of data with relatively stable structural environments in order to estimate those means with any precision. For something like biodiversity risk, which is plausibly priced today, it's very hard to make the case that 10 years ago it was priced in any markets at all. And so we've seen big structural breaks, which means the time series that we have to work with is going to be much, much shorter than what we'd need for this first approach. And so what we're going to use is an alternative approach where we're going to construct measures of aggregate biodiversity risk. And I'll talk about how we do that. And then we see whether or not that long-short portfolio, whether or not the returns of those co-move with the risk realizations. Again, the idea is if you find a portfolio that's long the firms that are very exposed to biodiversity risk, if that portfolio underperforms in periods where we have lots of risk realizations, that again would be suggestive of the risk being priced in financial markets. And the reason why the second approach is more promising is because, as we all know, in relatively shortish time series, it's much easier to precisely estimate covariances and correlations than it is to estimate means. So in order to do that, we need to first construct measures of aggregate risk, and then we also need to construct measures of risk exposures in order to allow us to form these long-short portfolios that I described. So how do we measure aggregate biodiversity risk? Here we're going to build on an idea that we've used in earlier work with Rob Engel as well, where we say, look, biodiversity risk, just like climate risk, is a very slow-moving risk where we don't observe a ton of high-frequency in-sample realizations. But what we can do is, in order to study the price responses to realizations of such a slow-moving long-term risk, we can look at price responses to higher frequency measures of news about future damages from the risk. So again, rather than saying, let's see if this portfolio goes up in value every time the Amazon forest gets destroyed, which, doesn't really happen at a very high frequency. What we can see is whether or not this portfolio goes up in value every time we get news about the rate at which the Amazon forest is destroyed. So the risk realization, the actual destruction, doesn't have to have happened yet. But when we get news about future realizations of the risk, and we can look at price that can also be indicative about the potential pricing of risks in financial markets. And so we're going to treat the concept of news quite literally, and we're going to construct several measures of aggregate biodiversity risk by studying coverage of news about biodiversity risk realizations in the New York Times. Again, given our focus on U.S. firms in this paper, New York Times as a US-based newspaper seems like a good starting point for this. We're going to take a relatively unsophisticated approach in the results that I'm going to be presenting to you today. We're going to define a dictionary of biodiversity-related terms, such as ecosystem, deforestation, etc. And then we're going to encode the sentiment of the article covering biodiversity risks, using a natural language processing tool. And then we're going to count whether or not in a given week or in a given month, there was primarily negative or primarily positive news about biodiversity risk realizations. Just as a little preview, we are updating our measures quite substantially since we first did this work. There's been, as you guys all know, huge progress in large language models, things like ChatGPT and others, that allow us to actually do a much, much better job at capturing time series variation in these risks. So we'll have an updated draft at some point with sort of a different risk measure, but that's what I'm going to present to you today. In the paper, we also construct a second index that's less about news, but it is about attention to risk. So we're going to look at Google search activity for terms such as biodiversity loss, species loss, etc. And we're going to see whether we're going to try and measure periods in which individuals pay particular attention to these risks. Again, the idea would be if the portfolio outperforms, in periods where we have a lot of attention to these risks, that would also be indicative of the pricing of these risks. So how does this index look like? So this is just a time series version of it. And one of the things you realize is that over time, biodiversity risk has gone up. And that biodiversity risk spikes around periods that in some sense make sense. So for example, the biggest spike came in a month when Trump announced changes to the Endangered Species Act. So that kind of first bit of indication that we are capturing something meaningful with this aggregate index. One big question that we had throughout the entire project is trying to figure out, and again, we were pretty open about what we would find on this, trying to figure out whether biodiversity loss was truly conceptually distinct from climate change, or whether or not they're broadly capturing the same type of topics. Now, climate change and biodiversity loss are obviously related, right? So climate change leads to further biodiversity loss as the climate changes, and certain species, have to move, etc. And biodiversity loss, leads to more climate change to the extent that, a lot of biodiversity is a carbon sink, right? So there's obvious relation between the two, but we're going to argue, and we'll have evidence for this, that in many, many important dimensions, they really are quite distinct, and they should be thought of as separate risks and as separate topics for broader investigation beyond sort of the financial market work that this paper is focused on. And one way to see this is if you use the same technology to construct a climate news index. So you're trying to figure out what are periods in which we get bad news about climate risk realizations. You see that they're somewhat correlated. In fact, I think the correlation is like 0.22 in the time series. But that there are many of the big biodiversity-related events, such as Trump's announcement of changes in the Endangered Species Act, did not result in spikes in the climate risk index. And similarly, a bunch of climate-related risk events, such as Bush's withdrawal from the Kyoto Protocol, did not result in spikes in the biodiversity news index. or the Biodiversity Risk Index, right? And so, while there are some common events such as wildfires, which lead to coverage of risk realizations of both climate and biodiversity risks, overall the two risks in the time series seem relatively distinct, and that's kind of a first, I think, important piece of evidence that it really is a standalone topic that I think should be studied separately. And I'm going to have a bunch of additional evidence on that just in a few minutes. So the next thing that we then need to do is we need to figure out the exposures of different firms or different industries to those types of risks. Because again, in order to study whether or not the risks are priced, what we need to do is we need to form long-short portfolios that go long, say, firms that are not exposed to the risks, and go short firms that are exposed to these risks, to try and study whether or not you get a positive co-movement of those types of long-short portfolio returns with risk realizations. There's a big challenge here. It's even bigger than trying to measure climate risk exposures of firms, which is something that I've spent quite a lot of time thinking about. The disclosure standards and disclosure frameworks for firms' biodiversity risk exposure are even less well developed than climate risk exposure measurements and disclosures. And so what we're going to try and do is we're going to have several different ways to try and measure different firms and different industries' biodiversity risk exposures. The first one, which I'll spend most time showing you today, is to try and study firms' 10K statements. So 10K statements are regulatory filings that firms have to make in the US with the Securities and Exchange Commission. And in those filings, they have to disclose all of their material risks to their investors. And so we'll use text analysis to study whether or not a given firm actually discloses biodiversity risk exposures, either of the transition risk or the physical risk types, to their investors. The second thing that we're going to do is we're going to go back to our expert survey where I showed you some initial results on. And we're going to ask people to rank about 20 different industries by how those experts perceive these different industries to expose in terms of their risk. And then lastly, we're going to look at the types of stocks and industries that the relatively few ETFs and mutual funds that are actively trying to be funds that benefit from, say, biodiversity regulation, what types of stocks those mutual funds would hold. One takeaway before I talk a little bit more about the three measurements is that all three approaches give us relatively similar rankings of industries in terms of their biodiversity risk exposure, which makes us confident that, again, we're picking up something that at least at a first cut seems meaningful. So again, we're going to have three different measures of using the 10K statements. One, which is just a very simple one, which just checks, do these firms identify any risk? Do they mention, in their risk disclosures anything related to biodiversity? The second one is we're going to try and be a bit more sophisticated and make sure that the sentiment in which the risk is disclosed is actually negative, right? That this is not, disclosed as there's a potential opportunity here. And then lastly, we're going to try and come up with a measure that really tries to hone in on the regulatory risk exposure rather than physical risk exposure. We're going to have these survey-based measures, as I described, where our survey participants were asked to select industries that they believe were most negatively affected either by physical or by transition risks. And then, so we're going to measure the physical and transition risk exposure, the share of survey respondents who select a given industries as being affected by the risk. And then we're going to, as I mentioned, have these 4 biodiversity-related funds, and trying to see what industries are overweighted relative to the market in those biodiversity-related funds to try and figure out what those fund managers think are the industries that are positively and negatively exposed. Okay, so over time, one of the things you see is that self-reported biodiversity risk exposures, as measured in the 10K statements, have generally increased over time, from about 1% of firms mentioning these types of risks in 2000 to about 4 or 5% of firms measuring these risks in about 2018. And actually, surprisingly, they've just declined a little bit since then. The other thing I think just to realize when you're trying to think about, well, is this going to be quantitatively as important as climate risk? You see that, with only about 4 or 5% of all firms mention those types of risks, I think you're going to get a much larger share of firms mentioning climate risk. Now, again, what's important here is those are US firms. And biodiversity risk, unlike climate risk, which is really global in nature, I think biodiversity loss is a somewhat more localized phenomenon. And I think as a result, the regulation in response to biodiversity loss are also much more localized. And therefore, you might be able to get much different, levels of risk exposures across different countries. But within the US, about 4% at the moment mention these types of risks. What are these sectors and industries that have the highest biodiversity risk exposures? It's energy, it's utilities, and it's real estate. And on the flip side, sectors such as semiconductor, software, and communication services have rather minimal exposure. So where does the exposure of energy, utilities, and real estate come from? Here's just some examples, again, coming directly from the 10K statements about how firms describe their own risk exposures. So in the energy sector, you hear a lot about reputational and legal risks, where drilling activities can lead to oil spill and habitat destruction. That's a big risk that they worry about. Or regulatory risk, where environmental regulations aim to prevent further biodiversity loss. So here's an energy firm that says if one of our LNG terminals may adversely affect a protected species, we may be required to follow a plan to avoid those impacts, right? So that's one example. In the utility sector, you have a lot of physical risks mentioned, so in particular in the water utility sector, degradation of watersheds, etc. In the regulatory risk sector, you're going to get a lot of mentions of species and habitat protection, limiting firms' ability to operate. The bottom example here is from the 10K statement, actually of a renewable energy firm, and I'll come back to that. The firm that says the company is subject to law regarding the protection of wildlife, including migratory birds, eagles, etc. And so these have become more stringent and actually make it hard for this firm, which is a wind energy firm, to operate. There's other examples here. So various types of real estate companies worry about endangered species protection. And then also firms in the materials sector mentioning both physical risks, in particular the availability of and quality of raw materials, and also regulatory risks. So this is a firm here that's in the timber sector, and it talks about various types of timberland protections may adversely affect their ability to operate. Lastly, I just want to give you one more example. To me, actually looking at these 10K statements, and we have a lot more in the paper, was really, really helpful because as I was just starting to wrap my head around the economic mechanisms through which biodiversity loss may affect economic activity, I found it personally really, really helpful to read how firms themselves talk about these risks and why firms themselves might or might not worry about it. So here's a pharmaceutical company that says we focus on the use of biodiversity as a means of natural product drug discovery, and as a result, sort of the loss of biodiversity would impede the R&D process. And then lastly, a firm in the capital sector says many consumers demand certified, sustainably harvested wood, as concerns about deforestation have become more prevalent. So again, this is a transition risk that comes less from the regulatory side, but from a change in consumer preferences. So these are just a bunch of examples of different types of industries and how they talk about their biodiversity risks. One thing that's interesting is when you're trying to rank firms based on their biodiversity risk, and you also rank them based on their climate risk, what you see is that, broadly speaking, there's like a small positive correlation, but there's lots of firms that end up being exposed to one type of risk while not being exposed to the other type of risk, or maybe even negatively being exposed to the other type of risk. So one example I want to focus on is the utility sector here, which was the second highest biodiversity risk exposure, but one of the most negative, in some sense, climate risk exposures. And when you open this up, what you start realizing is that much of this comes from the renewable energy sector. So the renewable energy sector is a sector that benefits a lot from climate transition risk realizations that make it harder for its competitors, oil firms, coal firms, etc., to operate. But actually, regulation in terms of biodiversity risk actually are really harmful for the renewable energy sector. Wind farms and birds, we already had a specific example from a wind company that says that, once you have to take into account migratory birds and so on, it's really hard to operate wind farms. Hydropower dams are very damaging to migratory fish. solar has huge land use requirements, and there's been an increasing concern that offshore wind leads to the death of whales. This is an article from the New York Times, in October, in August, and basically what they describe is they say, that groups have protested and sued to stop federal approval of wind turbines. They claim damage to whales with no firm scientific evidence behind it. But we're kind of seeing more and more examples of where regulation to stop climate change, which would need us to expand dramatically renewable energies, kind of come into conflict with regulations to stop biodiversity loss. Okay, so then we have these exposures across different firms and different industries to these risks. And then lastly, the question is, how much are these risks priced in equity markets? So what we're going to do is we're going to form equity portfolios of industries sorted by their biodiversity risk exposures. We're going to hold long positions in industries with low risk exposures and short positions in industries with high risk exposures. And again, if biodiversity risk is priced, the return of this portfolio should co-vary positively with the aggregate news index. This is a portfolio that should do well when we get bad news about either physical or regulatory biodiversity risks. Another way to think about it is this should behave like a hedge portfolio. Holding this portfolio should hedge the arrival of the news, should allow us to share the risk more broadly. And so when we do that, what we find is that the out-of-sample correlation between returns on this portfolio and AR1 innovations in the aggregate climate in the aggregate biodiversity news series sits somewhere between 0.1 and 0.2 in terms of correlation. Now you might wonder, well, 0.1 and 0.2 does not sound very high. And in some sense that's true. And for me, who's not a traditional asset pricer, I was rather disappointed when I started thinking about hedging macro risk factors and I saw correlations of 0.1 and 0.2. But it turns out that this is about as good as it gets, even when you're trying to hedge things like inflation or unemployment or things like non-farm payrolls in the US, just because stock returns are so noisy that getting out of sample correlations of 0.1 and 0.2 is actually pretty successful, and certainly suggests that investors are, at least to some extent, thinking about pricing these risks. You can also ask whether or not our measures of biodiversity risk exposure are simply recasting information from other firm characteristics. Another way of saying that is you can try and figure out whether or not, if you just try to form hedge portfolios based on a lesser regression on industry returns or a lesser regression on the factor zoos, so all of the risk factors that have been identified in the practice, or just the pharma French factors, whether or not those portfolios allow you to also hedge the arrival of the news. And the answer is they don't, right? So while if you take the average biodiversity risk exposures across all of our different approaches, you get an out of sample, correlation with the news realization of about 0.2, trying to use other mimicking portfolio approaches based on existing factors basically gets you a zero out of sample correlation. So what do we find? We find that biodiversity risk exposures do vary substantially across firms and industries, that the variation is economically sensible. When you look at the 10K statements, for example, these firms do describe very plausible mechanisms, and that long-short portfolios on these characteristics co-vary with aggregate realizations of biodiversity risk, and as a result, allowing us to conclude that the risks are priced. Now, just knowing that the risks are priced is sort of a relatively low bar. Rejecting the null that they're not priced is a relatively low bar. From the perspective of, say, a regulator, what you really want to know is if the risks are priced adequately. Why do you need to know that, or why is that the key question for you to look at? It's because if they're not priced adequately yet, you can get large repricing.
Sorry, Johannes. Sorry
yes?
to interrupt you. You have just 1 minute left, so if you can
I'm on my last
please.
slide.
Okay.
I'm on my last slide.
Thank you.
On my last slide. So it's very hard, so if they're not priced adequately, changes in the risk pricing and changes in beliefs about the risk can lead to large changes in asset prices without actually needing any additional information on whether or not any additional information about or any actual realizations of the risk. It's very hard to say if the risks are priced adequately. It requires structural models. It's the research frontier in the much more developed field of climate finance. We don't really know if climate risks are priced adequately. We know they're priced, but we don't know if they're priced adequately. So one thing that we did is we went back to our survey respondents and just asked them. And just as one data point, about 30% of people had no opinion. They had no idea whether or not these risks were priced adequately. To be honest, probably more than 30% didn't, but the rest at least gave us some indication. And out of those that gave us indications, 2/3 said that they're not yet priced adequately. Okay, so that's the conclusion. So this is really the beginning of of dipping our toes into better understanding the financial implications of biodiversity loss. We introduce measures of both aggregate biodiversity risks as well as measures of exposures to these risks across firms and industries. We try and study the pricing of these risks in equity market. I think we can reject the null hypothesis that they're not priced. We have made no progress in terms of trying to figure out if they're priced adequately beyond asking people and realizing people think they're not, but that doesn't mean they're not. I want to remind you that all of these measures across firms and across industries we release at biodiversityrisk.org. So if you want to work on this topic, and I hope many of you will, you can use those as a starting point for your own work. And I'm going to stop right here. Thank you very much.